Hello, everyone. Welcome to today's webinar. This is part 4 of this groundbreaking complimentary 8-part webinar course that is designed to support financial advisors as they navigate this new world of blockchain, cryptocurrencies, and digital asset investment opportunities. I'm your moderator, Dara Albright, co-founder of D-Wealth Education, a new edtech platform dedicated to providing incentivized learning to financial professionals, business executives, and modern-day investors. Today's session is going to take a deep dive into more advanced cryptocurrency investing and income strategies. This is a vital topic, especially with inflation at 5.4% and climbing, savings accounts offering a measly 0.5%. If you're lucky, 10-year treasuries yielding 1.6%. And this is, for these reasons, more and more advisors and their clients are turning to crypto lending and DeFi lending for yield. And that's going to be the topic of today's discussion. I'm excited to dive in. Today, our distinguished presenters are Jahan Jamali, CMO and co-founder of Sarson Funds, and Blake Richmond, Senior Portfolio Manager at Sarson Funds. Now, Jahan, as you already know from previous sessions, is a former intelligence officer and leading expert on emerging technologies, global risk management, and international relations. He's a renowned cryptocurrency educator and is routinely sought by the media to talk about the intersection of cryptocurrency, blockchain technology, and security. Blake, you have already met from session 2 as well. Blake is a senior portfolio manager at Sarson Funds, and in that role possesses an extensive background in blockchain-enabled finance, venture capital, and tokenization. Before I hand over the mic to our experts, just a couple of items I just want you all to be aware of. One, the webinar will last an hour. And that will be 15 minutes of presentation time and 10 minutes for Q&A. The Q&A is reserved for the end of the session, but you are welcome to type in your questions into the public chat as they come to you. Just remember, number one, we won't be answering them to the end. And if you can, just please make sure to put a question mark next to that question so we could distinguish between a question and a comment. Also, please keep the comments and questions related to the presentation here today. And remember, no advertisements or any of that sort of thing. Just all relating to this discussion today in education. Also, as a reminder to everyone, Investment and Wealth Institute has accepted this webinar for 1 hour of CE credit towards the CIMA, CPWA, CIMC, and RMA certifications. And now, regardless of whether one has that certification or not, everyone who completes the entire 8-part program will earn a level 1 crypto advisor certification from Sarson Funds. And that will demonstrate your cryptocurrency and digital asset expertise. The completion certificate will be issued at the end of the course as a non-fungible token, an NFT, which you'll learn much more about today. This is an industry first. It really is groundbreaking, something we're really very excited about. And with that, I'm going to hand the mic over to you, Jahan.
Thanks very much, Dara, and thanks everybody for joining us once again. If you are returning, thank you. We hope you've enjoyed the series so far. If this is your first time with us, sit back and relax. We're going to dive a little bit deeper into the weeds than we have in the past. I'd like to thank Blake for joining me again. We're really excited to go over today's webinar. What we're going to be covering today in session 4, we're going to be diving a bit deeper into investment strategies and ways in which you can invest in crypto beyond what we covered in session 3, which was the mechanics of opening a personal wallet and what the different wallet types were and some of the basics of how everyday folks would approach cryptocurrency investing for the first time. Today, we're going to go a little bit more in depth and into some more detail into different ways in which you can invest in cryptocurrency and digital assets. We're going to start off, we're going to talk about token offerings, and we're going to talk about what those are and the different types of token offerings that are out there. And we're going to talk along with that on what it means, what tokenization and securitization means with regard to digital assets. We're going to talk about the universe of stable coins so that everyone has a good understanding of what a stable coin is and why you might consider one and where they would sit in a investment universe in digital assets. And Blake's going to talk in depth about derivative options as well. We're going to talk about futures. We're going to talk about options. We're going to talk about synthetics. I'm really excited for that section as well. And then we're also going to talk about liquidity provision, right? We're going to talk about liquidity pools and yield farming, what that all means. And in addition to the deck today that you'll get at the end of the course, or end of today's session, we're also going to be sending you DeFi Demystified, which is a white paper exclusively on DeFi and decentralized finance that Sarson Funds published several months ago. So we want to make sure you guys get a copy of that. And then we're going to talk about staking and staking rewards and what those mean. And then we're going to wrap up today talking about a topic that I really like a lot. We're going to talk about NFTs. I'm sure you guys have heard a lot about NFTs. For those that complete the eight-session program, you're going to get an NFT, a non-fungible token, as your certificate of completion. But we're going to talk about that a little bit. I'm really excited to go into that section as well. So, without further ado, let's talk a little bit about token offerings. All right. So, what is a token offering? Well, we have two different distinct sets. We have what was known originally as an initial coin offering, and then we also have something a bit more mature, which are regulated public token offerings. Now, a token offering, initial coin offering, is when a quantity of cryptocurrency is sold in the form of tokens, and this is usually in conjunction with the launch of a project. And it's usually sold in either an exchange for fiat currency, where you can buy an initial tranche, or from a more established cryptocurrency where you can purchase this initial coin offering with Bitcoin or Ethereum. Tokens in an ICO are promoted as a future functional currency, and that's also predicated on if the ICO meets its funding goals and if the project ends up successfully launching. ICOs quite often are publicly crowdfunded, but they can also be privately offered as well. And as the universe of cryptocurrencies has expanded, we've seen an enormous growth in the number of tokens launched and projects that have commenced. And as you can see by the chart from CoinDesk, as of 2021, it's a pretty compelling line with the number of cryptocurrencies that were created. Now, regulation has been a bit slow to catch up with this, as I'm sure you guys have been following, or those that are into the crypto space have been following the context of, okay, is this a utility or a security? And there's a pretty prominent case happening right now with Ripple Labs and XRP, and we're going to see how that plays out. But as the space started to grow and develop, regulators and as well as the cryptocurrency crowd itself started to grapple with this concept, and we have what's called a regulated public token offering. And these are referred to as a security token offering or a tokenized IPO. Now, a regulated public token offering is a type of public offering in which a tokenized digital securities are sold in a security token exchange. And they are as securities. They're subject to U.S. securities laws and fall under the jurisdiction of the SEC. And one of the core debates, which has gained a bit more clarity over the last year or two, has been involved brokerage custody laws as well as bankruptcy protections too in a regulated public token offering. And Blake, I didn't know if you wanted to add any more insights here on the token offering concept, but I'll hand it over to you for a moment if you'd like to.
Yeah, on regulated public token offerings, it looks and feels a lot more like equity or traditional equity round. It's basically representing your ownership digitally in the form of a token. There's still a cap table involved. There's still a transfer agent and potentially custodians as well when these things start getting traded. But the core point is that an asset can really be tokenized at any point in its life cycle. If you're doing a seed round and just want to offer tokens rather than papered equity, that's entirely doable. But similarly, the benefits of liquidity that's provided by this tokenization It also appears to more established and seasoned assets like later stage private equity, as well as real estate portfolios.
Yeah, and I gave you this easy kind of simplified visual too to give you an idea of the trajectory of an ICO versus maybe a security token offering, where at the end, ultimately, it's consummated with a token distribution via a smart contract on the blockchain. And as Blake was mentioning too, this has a handful of different use cases, and we're seeing, and I suspect that we're going to see a lot more tokenization and securitization, and especially in the real estate world. REITs, have a lot of blockchain potential in this, so I would have that as something that I would keep an eye on. Now we have with regulated public token offerings. Let's break it down into public versus private ones. The public token offerings are going to either fall under Reg A or Reg CF or CF Plus. Reg A is going to be obviously reviewed by the SEC, and the company is going to report publicly. And there's two tiers along with Reg A public token offerings. Tier 1 where the raise is up to 20 million, and a tier 2 where the raise is up to 50. Now, Reg CF or Reg CF Plus has become really popular for the crypto crowd. These are crowdfunding options, and there's a variety of crowdfunding platforms out there that support this type of offering. Republic is one that's pretty well known, where projects like you had your crowdfunded startup platforms that arose a handful of years ago. Well, now these are more blockchain oriented. And I believe now that they've raised what the initial limit was. I think it was 1.1 or 1.2 initially, but now you can raise up to 5 million in these types of crowdfunded token offerings. Now on the private side, with private placements, there's Reg Ds, and there's exemptions here for private offerings under Reg D token offerings. They're going to fall either under Rule 506B or 506C if they're for accredited investors. And there's no annual offer limit there on those types of offerings. Now, if there's a private placement there that's not for or open to non-accredited investors, it's got to fall under Rule 504. And those offerings are going to have an annual offer limit of 5 million. So let's move on a little bit from token offerings. Now that we have a bit of understanding of what the distinction is between traditional original type of ICO and how the space has matured into regulated token offerings and the jurisdictions that they fall under. So let's talk about stablecoins for a minute. So what is a stablecoin? Well, a stablecoin is a digital currency that's pegged to a stable reserve asset. And that could be anything from an existing fiat currency to a commodity. So these are a category of digital assets that are pegged to some sort of stabilizing mechanism. And I'm going to talk about a mechanism that's non-commodity and non-fiat based here on the next slide too. And they're effectively digital representations of what that currency, fiat currency, or commodity is. Now, why would you consider a stablecoin? Well, there's a handful of reasons why you might consider one. They have advantages that are very similar to crypto, and that they're fast, peer-to-peer, they're borderless, and they're available 24 hours a day, 7 days a week. The difference is, unlike on non-stablecoin cryptocurrency, is that its value is fixed in relation to what it's backed by or what it's pegged to. And we're going to go over what the different types of those as well. Now, if you are in if you have a diverse portfolio of digital assets, stablecoins are not a bad option if you want to go to like a risk-off, part of your portfolio, right? You want to stay in the digital asset universe, but you want to move out of some of the the core cryptocurrencies or other types of digital asset investing vehicles. You can almost view it as like a money market option, where you want to move something into like USDC, US dollar stablecoin, which I'll talk about here on the next slide. But they serve a really distinct purpose and provide a bit of a hedge against what a lot of people see as the volatility in the space, where you can still stay within the digital asset universe, but not have to absorb some of the volatility that you might see in the rest of the crypto space. Along with the DeFi white paper, you'll get this as a slide too, but I'll make sure that Janelle sends this as a separate. This was an infographic that we published at Sarson Funds, which gives you sort of a breakdown of at the time what the stablecoin universe looked like. And you have your fiat-backed stablecoins, and we indicated a handful of these here. Folks, of course, have heard of Tether, USDT, but we also have Paxos Standard USDC, which is run by Center and in conjunction with Circle, as well as Binance USD as well, True USD, Gemini Dollar. We also have physically backed ones that are collateralized or backed by a commodity. We have gold-backed stable coins. We also have algorithmic stable coins or crypto-backed stable coins like DAI, where DAI facilitates fiat trading using Ethereum without it doesn't have the centralized control of other types of stable coins, where it's algorithmically backed by the collateral that's passed through it. But I'll make sure you guys get a separate copy of this too. This is kind of a handy cheat sheet. Now with that, I'm going to turn over to derivatives. We're going to talk about futures, options, and synthetics. So Blake, I'm going to let you take the stick from here.
Yeah, thank you. On the side of futures, there's two publicly available venues in the US, and that's CBOE and CME. They allow for financially settled Bitcoin futures with a fixed expiration date. Similarly, there are other venues that operate as outside the US and offer perpetual swaps. There's also venues on chain that allow for this type of trading activity. And perpetual swaps are very similar to futures. They're just open in perpetuity. And the way that is addressed is by having a funding fee every 8 hours or so, where depending on the skew of the book, either shorts pay longs or longs pay shorts. But it's become a very popular option for crypto traders today. And I think comprises some of the most liquid markets in crypto. On the side of options, the only real CFTC blessed venue for this is Ledger X, which was recently acquired by FTX, which is another crypto exchange. There's also globally available venues outside the US, such as Deribit and a few others. And this looks and feels a lot like options do in traditional markets. You can have calls, puts, and multi-leg strategies where you assemble different combinations of these things at different strikes.
Blake, let me ask you a question that I think that a lot of folks might ask. In terms of futures, we see that in some of the crypto markets that there's some crazy leverage available, and those aren't typically available here in the United States. But what are your thoughts on those, and whether they pose a risk, and if they have a future here in the United States, the types of leverage that's offered in some of the international markets, and if that has been a sort of a driver of some of the volatility in the space, or some of maybe the negative media coverage?
Yeah, I wouldn't say it drives a lot of the volatility. It definitely drives reflexivity. You'll see on this chart on the left that the open interest, which is sort of a function of leverage on the underlying, when it creeps up to a pretty high amount, that starts to introduce higher reflexivity in the market, but not necessarily more volatility. The counter to that is really like Forex allows much higher rates of leverage than you'll typically find on crypto exchanges. And crypto exchanges do have just empirically worse matching engines and liquidation engines than their traditional counterparts. And they know this. So they tend to cap these leverage rates either by the amount of leverage that you're allowed to use or the size of the notional position using that leverage.
All right, thanks. I'll move on over here for you. Let's talk synthetics for a bit.
Yeah, on synthetic assets, these are almost similar to stable coins, where there's a reference asset and a trading environment tied to that reference asset. In the case of synthetics and mirror, they basically have a asset which you can buy or redeem at a specified Oracle price, and that Oracle price is basically picking up the global spot price for that asset, so that you're able to complete this kind of closed loop arbitrage. And within that, sometimes the asset, just based on trading activity, will deviate from the Oracle price, and traders will come in, arbitrage it, and return it back to that global spot price. There's also the availability for users to contribute liquidity to these trading environments, and traders and arbitrageurs that are coming into the environment with every trade are generating trading revenue for liquidity providers. So this allows for pretty unique series of markets. You see this with stocks under Mirror Protocol, more derivatives under Universal Market Access, and Synthetics has a number of stable coins, synthetic Bitcoin, synthetic versions of Ethereum, but then also things that look more like inverse ETFs, leverage ETFs, and it just provides another way for users to gain exposure to certain assets that aren't necessarily available at other venues.
Now, Blake, let me ask. Now, these examples that we have here, Synthetics, UMA, and Mirror, you can buy these protocols on some commercially available or retail available exchanges. But how would one access the platforms?
Yeah, so this is done on chain. So these three platforms you would connect a MetaMask wallet to, or similarly Web3 enabled wallet, and that website is now picking up the contents of your wallet, and you're able to interact with it as you might do in another venue. The interesting thing is that this kind of occurs on a UI that sits in front of the smart contract that these are based on. That smart contract can be interacted with on chain completely outside of any website or app that you're going to access these things. It basically functions as a chunk of immutable code that's out there for anybody to come in and access. For the less technically savvy, having a UI and an app to go in and interact in a very familiar and intuitive way is going to be a lot easier. But there's, I think it's kind of cool that, like, one, you can access to the UI and app, and two, that this stuff will live on even if the app gets shut down.
Well, let's talk about liquidity provision and maybe how that parlays into this as well.
Yeah, and I mentioned liquidity provision earlier with regards to synthetic assets. Similarly, there are now decentralized exchanges and lending markets where users can provide whatever liquidity they have and generate either trading fees through arbitrageurs and traders trading against that pool of liquidity, or from borrowers that are now borrowing that staked collateral. So this introduces a couple new investment techniques. In the case of liquidity mining, or as it's sometimes termed, yield farming, you're able to provide liquidity, but also in addition to the trading fees that a user is generating, you're also in some cases being incentivized by the protocol to provide that liquidity. So given your pro rata share of whatever pool you're providing that liquidity to, you might additionally generate governance tokens or some other form of liquidity incentive rewards for that provision activity.
Now, is slippage a concern on these?
Slippage is not a concern on these. In the case of liquidity or liquidity pools, you typically provide two assets in an equal ratio, and by design, these pools are naturally rebalancing the quantity of asset one and asset two back to so that the notional value is roughly 50-50. In that case, if one asset appreciates significantly against another, you might might have been better off holding that one asset outside of the pool and not suffering from this automated rebalancing function. But similarly, on the downside, you might have been better off contributing these things to a pool, having that automatic rebalancing. So there's some new portfolio management techniques that kind of arise from the natural architecture of these things. But slippage is not necessarily a concern for liquidity providers. It's more of a concern for traders.
Now, what would you say are the top risk factors, with liquidity pools and with yield farming for someone that's kind of just starting out?
I think the longevity of the platform is probably the biggest risk. There's some established venues that are more reputable. They were the ones that had originally designed these pool architectures and, the bonding curves that they reside on. And, that's who you can really trust with the, when you're providing liquidity. But there's also newer platforms that, might be incentivizing the liquidity at a much higher APY than, the venue that you might have otherwise traded at or provided liquidity to. And sometimes, when you're providing liquidity to these things, you should be conscious of how much value is locked in these, as well as how long that value has been locked. Because if this is, just a honeypot that is kind of, it might be hackable or it might not. If you've had, several $1 billion locked in it for 18 months, that seems like it's going to be, theoretically much more secure than something that's had, say 25 million locked in it for the past, couple months.
Now, Blake, not that we're going to provide any official endorsements or anything, but what are some examples of platforms that have been around for a while that might have sort of a good reputation?
Yeah, this is going to be things like Uniswap or Curve Finance or Balancer Exchange. They all sort of developed different math based on the same fundamental bonding curve that provides this kind of 50-50 balance. Most decentralized exchanges that use this type of architecture have forked the code base from one of these venues. And you can see, if you look at the smart contract and basically redline it against its predecessor, that typically they're all kind of using the same fundamental code base. So I think it's probably more of a you're better able to mitigate risk by using whoever developed that original smart contract rather than whoever's basically copied and pasted and then added whatever logic or externally owned functions.
Now let's give the audience an idea, sort of like the size. What's the typical volume kind of band that's flowing through some of these liquidity pools?
It changes. It's very nuanced, kind of market by market. But what these pool architectures have the effect of doing is providing more liquidity at the money than some of their closed order book counterparts that you might see in a traditional setting. And this means that larger players are able to come in and trade and experience less slippage than they would on a traditional CLOB exchange. And
in terms of APY, there's quite a bit of variance in APY that can be realized with some of these pools, right? What have we seen across the board? I know it can be quite varied, but
it's going to vary day to day. It's going to vary by pool size and going to vary by the amount of trading activity within that pool size. Some of these things are returning, over 100% APY to liquidity providers. Some of them are doing in the 10 to 20% range. So it's a little bit case by case. And in any case, it'll be variable throughout the year in any market.
What have you seen as typical length of time that someone would utilize this for?
It's I like to use it as a sort of de-risked savings product. It's something that you can take your long exposure, and you can kind of think about this as like an automatically rebalancing ETF type of instrument, where if you wanted to, provide or hold a portfolio of 50% Bitcoin, 50% Ethereum, you're able to maintain that 50% ratio automatically by providing liquidity to the ETH BTC pool, but with the added benefit of generating additional income on top of it.
And I'm sure that if you guys are, I'm sure, going to have questions, feel free to put them in the chat, and we'll make sure we save enough time at the end of today's session to field as many as we can. And you'll get our contact info as well if you guys have follow-up questions that we might not have otherwise gotten to. But you'll get some additional information on this in the accompanying DeFi Demystified DeFi overview that you'll get alongside this deck, which will walk you through some of these examples as we have down here. There's a handful more of those in that white paper, and I think you guys will find it very useful. So let's move on a bit to staking and staking rewards, Blake. So let's give an overview of what staking is, why some cryptos can't do it, why some can do it, and what it all means.
Yeah, staking is essentially kind of, I guess there's really two areas where it's relevant. There are proof of stake blockchain networks where, in the case of Bitcoin, which is proof of work, that amount of computing power basically represents a economic cost to bad behavior. So if you're expending enough energy, you're going to be less incentivized to confirm malicious transactions.
Yeah, let me just review to remember, guys, from like our first sessions. Proof of work and proof of stake. These are the consensus mechanisms. This is what makes blockchain and crypto so unique, is the way that transactions are verified. And this is the core distinction that Blake is referencing. And this has to do with protocols that utilize proof of stake. So Bitcoin uses proof of work, and that's the delineation that we're making.
Yeah, I mean, just when you're thinking about validating a network, there needs to be some sort of opportunity cost or an economic cost to users that would dissuade bad actors from participating. Staking is one way of achieving this, where you contribute the value that you already own. You prove the stake that you have in the network, and if you are caught acting in a malicious way, then that value, one, is suffering the opportunity cost from being locked, but in some cases can be slashed, or the rewards can be slashed. So in Tezos, in Algorand, when ETH 2.0 merges with ETH 1, you'll see more of this type of activity where users are pledging the value that they own in a way that helps to validate the network. And in return, they're earning additional income on the value that they're staking through these staking rewards, which is typically a combination of new supply being emitted to stakers, as well as transaction fees from whatever activities occurring on the network. There's another area where you can stake, and this is going to look more like governance tokens, which are tokens derived from these layer 1 tokens. And sometimes you can stake these tokens and use it as you can basically use it as a stake weight, which would translate to how much influence you would have in a governance vote, or in some cases you're able to stake these things for a share of protocol revenue. So in the case of Sushi, which is the governance token for SushiSwap, if you're staking the Sushi token, you're able to vote with that balance on new protocol upgrades, new features, but you're also participating in revenue share from the revenues that the underlying protocol is generating from trading activity.
And like the staking rewards, percentage kind of varies, right? I know folks that have Coinbase, you can see which digital assets offer staking rewards, but generally they're not consistent across the board. There's a bit of variance, right?
Yeah, it really depends on the stage of the network. It depends on, if it's a layer one token like Ethereum or Tezos or Algorand, earlier in the life cycle, these things are typically going to have higher rates of rewards, and that's just due to a smaller community that's pledging that liquidity, as well as typically higher rates of emission of new supply. In the case of governance tokens that you're staking for revenue share or new supply, that's going to vary, based on the revenues generated from the protocol, and that can vary day to day based on trading activity, based on liquidations if it's a lending market or new loan originations. There's a lot of nuance at the governance token level for how these staking reward APYs are actually achieved.
All right, thank you, Blake. So there's an enormous amount of possibilities and potential, to earn in different ways from participating in the consensus mechanisms with staking and staking rewards, which is why they've become, so popular. And a lot of folks in the crypto space feel that it broadens the appeal for digital assets in which holders that choose to utilize staking, can participate in the success of the network and can participate in the successful transaction confirmations. And it does give you a lot, significantly more options than just sitting back and trying to collect a low APY from a savings account, which is part of what's driven its popularity. Now, I see that we've got a poll question coming on. Most of our audience has not participated or earned staking rewards. I would suggest that for those that have a Coinbase account, you can read about it. They have some good educational modules. You can browse through the tradable assets and you can see which tokens offer staking rewards. And the best way in which you learn is to put your money into it or invest and try it out, and see what you feel comfortable with. So it's definitely not a bad option. If you're thinking about it, there's definitely plenty of information on some of these wallets for you to get an understanding of how you can earn staking rewards in the tokens that you choose. We're going to talk about staking here a little bit also in our next section. Let's talk NFTs for a minute. I know they've been very popular. I'm sure people have heard of them. Non-fungible tokens. We're going to talk about what they are, what they mean, and why they have value, how they differ from cryptocurrencies. And I'm also going to take this opportunity to show off some ones that I own. I'm a big fan of NFTs. I've always felt that cryptocurrency adoption consumer adoption would happen through NFTs. And we're starting to witness some of that now. So I feel somewhat validated. But they're more than just art. So let me explain to you what they are, what they're not, and how they differ. So a non-fungible token is exactly that. It's non-fungible, right? You can trade a Bitcoin for another Bitcoin and it's par value. I can't trade a non-fungible token for another non-fungible token necessarily because they're different. They're unique. And it's a non-interchangeable unit of data that's stored on the blockchain. So what does that mean? What does that do? So an NFT can represent a real world object. And we've seen that happen, it's in the art world. And so they can represent objects like art, music. If you're big into gaming, in-game items, as well as videos and other types of media. So they're representing not only possible physical, like ownership of a physical asset, but they can represent digital assets as well, like a digital file. Like you want to think of this also not only as like, hey, I own a piece of digital art and it's represented here with this non-fungible token, but it also serves as your certificate of authenticity. And it also serves as, by the nature of how it's constructed, as potentially a license. So you can even think of a licensure if we're going to move forward a couple years into where certifications are offered, like we're offering now. It's going to be represented as an NFT. It's a non-fungible token that belongs to you, and it's not necessarily equal to another type of NFT that's out there that says that you, Joe Smith, completed this course. Here's what the course was all about, and it's unique. So it establishes and verifies a public way and proof of ownership or certification or validation. So that's part of what makes it so special, right? Is their uniqueness, and oftentimes they're either a sole item of uniqueness or they're part of a limited run or a part of a limited collection, and it has a unique identifying code around that. Now, part of what's driven the popularity is because this has created a more efficient way of validating authenticity, especially with brands, right? You could have an NFT back a product and like Louis Vuitton. All right, we've all seen Louis Vuittons. Like, if you go to a big city, sometimes you see the fake Louis Vuittons, out on a sidewalk. How do you know it's a real or fake Louis Vuitton? Well, Louis Vuitton is really big in NFTs, and are marking and validating their physical products with NFTs to provide it with a seal of authenticity that's immutable, undeniable, and publicly available on the blockchain. So it protects brand value in an enormous amount of ways. And ultimately what this does too, in the areas that it touches, it creates digital scarcity because they're unique. So let me talk about a couple that I have, right? And I'm sure that we might have a few folks that might have either collect art or collected baseball cards or sports collectibles or memorabilia as a kid or as an adult like I do, but it hits some of these same areas. In art and in collectibles, sports memorabilia, there's always this sort of like, oh, is there a seal of authenticity? Is it verified? Is it, if it's a sports trading card, is it rated by Beckett or one of those other like legacy grading systems? And there's that's part of the risk factor in these. Well, this can be mitigated here with NFTs. So let me give you two cool examples of NFTs. I just happen to own them. One is Alto City. I own this. This is a map of San Marino. And Alto City NFTs are artistic maps of cities around the world, each either in an homage to a known artist or in different color schemes. But the NFT is actually backed by physical merchandise, so that they also have a consumer-facing store that sells prints of all sorts of stuff, from scarves to neckties to to phone cases to actual prints of these images. And part of the utility in this type of NFT is that the holder of the token gets a percentage of sale off any merchandise that their print was, or the print they hold was, used or sold. So if anyone buys a necktie or a scarf or a phone case that has this print on it, I think Alto's is 7%. I get 7% of the gross sales on that. Mark Cuban's a big fan of these. He's a big fan of NFTs in general, but I thought that was really cool. And actually, my wife has purchased a giant blow up of this to put in our dining room because I also think it's a great piece of art. Another one on the more sports memorabilia side. This, I wish I could click it and have it play for you, but this is actually animated. This is the Boston Celtics, and the NBA in general has been really big in releasing clips of highlights and releasing them in these digital packs. So it's called NBA Top Shot. But each franchise started minting their own collections, and I'm going to talk about what minting means here in a second, in case you guys don't know. But I happen to own one of the 7 Boston Celtics 1986 championship banners, which, for those of you who don't know, this is the greatest team in NBA history. Don't let anyone tell you otherwise. But that has meaning to me. And, there's one of 7 of these. I happen to own one. But, that's another way in which, brands are starting to connect with their fans in different ways, and utilizing NFTs as a vehicle to do that. So let's talk a little bit more about some other types and, the expanding market. So the NFT market has exploded. Influencers, artists, music artists, filmmakers, digital artists, traditional artists, they're looking for different ways to connect. And NFTs not only represent a either a product of the artist or a product of the producer, but they also represent sort of an access pass to a community. And there can be different levels associated with that and create different types of utility. I've always felt that consumer rewards programs in general were highly inefficient and were ripe for NFTs. So like your pharmacy rewards card or your rewards card that you might have at your local supermarket. Like you go to CVS and they print you off 10 miles of paper receipts. There's value there that's unclaimed because I guarantee you don't use them all. And it's not really an effective method. But what if there could be tiers of membership within a consumer rewards program for a particular brand or particular store? That's actually much more efficiently represented on a blockchain, and the value there is much more easily captured. And you have a different way of being able to reach back and reward members of your community or fan base. So let's talk about some of the mechanics, right? So it's not all crypto tokens support NFTs, but a handful do, right? It's effectively a contract. So obviously Ethereum is the most popular token that supports NFTs protocols. Also Solana has really gained a bit of market share in Ethereum. And one of the one of the ribs on Ethereum is that gas fees can fluctuate, right? Your transaction charge can fluctuate based on the activity on the Ethereum network at a given point in time. So Solana's fees are much more predictable and typically less. And Solana's become a very popular token platform to house non-fungible tokens, as well as Bitcoin Cash, as well as Tezos and a handful of others. Now, how do you buy these? Well, you can buy them in really two core separate ways. You can either purchase them from the initial sale, and what happens here, it's called a minting event. It's when the producer of the NFT or the NFT collection is launching. And typically what you would do is you would, oftentimes these conversations happen on Discord or Twitter, but the producer of the NFT or the NFT collection would have a launch date where you can connect your MetaMask wallet, which is a popular wallet or other type of wallet, to the website, and that you can mint and purchase at whatever their initial price was. Of course, you got to do your due diligence and your research on these. And we'll talk about that in the risks section. But on popular collections, the minting can sell out fast. I've seen them sell out within minutes on a collection that had 10,000 items. And what happens is you'll get that token, you'll get that contract in your wallet, and you'll see which one you got, so to speak. And then you'll be able to, if you want, put those on a secondary market. So popular secondary markets are OpenSea, Rarible, Nifty Gateway, and there's a handful of others. Big auction houses, big art auction houses are really getting into this as well, partnering with some of these platforms. Sotheby's, for instance, is partnering, and a handful of others. But you can purchase NFTs on these secondary markets. Some are purchased in an auction format where you'll have an open auction for like eBay. Others have like a buy it now option where, or you can make an offer and see if it gets accepted. There's obviously considerable amount of risks in NFTs, right? Just like there's considerable amount of risk in any type of art or collectible. One, it's a new frontier in crypto, and crypto is also a new frontier in and of itself. So there's much more limited history with NFTs than there are with the rest of the crypto space. And just like any type of intangible or any type of product that's artistic or collectible in nature, it's really the value is based on what somebody's willing to pay. So you're not necessarily going to have like the immediate liquidity that you'd have with a fungible digital asset, like your traditional cryptocurrencies. Also, don't forget, tax man's out there. NFTs can be subject to capital gains tax. We've seen some, enormous gains for some collections, and well, the tax man's not going to ignore that, I can assure you. So what I would suggest is obviously you got to do your research, understand the risks, proceed with a healthy dose of caution. I would say probably even more so than your regular standard cryptocurrencies. But I wanted to give you a couple examples of some different kinds. One is I put up here called Crypto Mutts. This is from a 10,000 item collection from contemporary artist Kenny Shader, I'm a big fan of. And I just recently found out that the most rare Crypto Mutt, which is not that one, is going up for Sotheby's in December. So this, I think, is a good moment for the contemporary art world, which is finally starting to make its way over into the digital art NFT space. Could be a good bellwether event. Also, one that I find that has a unique distinguishing quality is a collection I got into not long ago called Head DAO. Now, a DAO, D-A-O, for those of you that don't know, stands for Decentralized Autonomous Organization. Think of it like a programmatic LLC or programmatic fund, so to speak. So members that purchase a Head DAO become part of the DAO. And the DAO utilizes the initial sale proceeds from the collection as well as proceeds from any resales to fund the DAO's treasury. And as a DAO member, as a holder of one of these tokens, you get to vote on what that treasury does. And that treasury is programmed and designed and built into their rules to purchase other blue chip NFTs to hold in its vault. So by default, you become a fractionalized owner of some very popular collections. And it's been moderately successful. And there's a handful of collections in there like Bored Apes or CryptoPunks, if you guys are familiar with the NFT space. And you can stake your your Head DAO on their platform to receive their token called Head Token. And that token represents your fractionalized ownership of the assets that are in the vault. So I thought that was kind of cool. So I ended up getting one of those for my personal collection. These are not endorsements in any way, shape, or form, but I did think that they were interesting examples of the different and varied ways in which you can utilize non-fungible tokens. And with that, that brings us up to our Q&A time. I hope you guys have a lot of them. If you guys, if we don't get to all of them, we'll be sure to respond back. You'll get our contact information afterwards. But I do want to quickly talk about, we're in session 5, which is our next one. We're going to talk about how to safely invest in digital assets. So this is important. Safety and security above all, risks and taxation. So make sure everybody tunes into that. But with that, let's turn it over to questions.
Yeah, we have a ton of questions, and I think maybe let's start on all the NFTs, since there were a ton that were coming in as you were talking there. So let's start with one. How is an NFT created?
Well, it starts off from a lot of them. It starts off as a file, so that could be a PNG file, a JPEG, a GIF, a video file, and there's a handful of platforms. You can create one right on OpenSea, where you upload it, and it creates an address for it on the blockchain, and it's actually quite simple. And there you have it. You've created an NFT. Now, just like I can sit here and make a doodle and drawing, doesn't mean anyone's going to buy it. But they're relatively straightforward and pretty fast to make.
It's amazing. So, talk a little bit about how you get the payout on the Alto City NFT.
So if on those, they have a front end that's consumer facing where you can buy products, and each print is associated with a collection of products and associated with the wallet address for that product or the contract address for that product, which is tied back to my wallet address. So anytime there's a purchase made back on there on the physical item, it's already tied, and I get a percentage sent right to my Ethereum wallet.
And so you get paid in crypto? Is that how it works?
Yeah.
Okay. Because that was another question there. And what about so you get paid, but also the value could fluctuate as well.
It could.
So there's a chance
could go up, could go down.
Which I was thinking about that too. Do you foresee at some point regulators actually looking at NFTs and deeming them a security?
It depends. It depends on the way in which the NFT project is rolled out, but it certainly runs into that risk. Blake, do you want to talk a little about how an NFT might be classified as a security? We talked about that the other day.
Yeah, I mean, in the case of something that's returning royalties, that looks like a revenue sharing contract, and it would fail the Howey test and look more like a security. There's no real precedent in that area, but it's definitely something to be aware of.
Yeah, that'll be interesting to see how that plays out. And then as far as storage, what's the best way to store NFTs that you personally own?
Well, I mean, I store them on most of them on my MetaMask wallet, for my Ethereum-based NFTs. And of course, I got my security recovery phrase stored away separately, offline, just as the security precautions we mentioned in our session before on crypto investing basics, and we'll talk about that in the next session too. You can move them over into a cold storage wallet too, and depending on what blockchain they're on, whether it's Solana or Ethereum. But I generally hold them on MetaMask, and I sync my MetaMask wallet with my OpenSea account.
And that brings you to the IRS also. Are NFTs considered collectibles by the IRS? And then, if that's the case, are they prohibited asset class for IRAs?
There's no IRS guidance to that effect. From the tax professionals I've spoken with, they all would opt to treat this like capital gains. But I don't think that means one way or the other, whether it's a qualifying asset for qualified money.
That's a great question. That'll be interesting to see how that plays out. Okay, so here's another question that came in. I lend my crypto on BlockFi to earn 4.99%. Is that a good investment? I don't know if we can give investment advice. But...
Yeah, I mean, digital asset lending is certainly a thing. Blake, you want to give a quick 30-second on what rehypothecation and digital asset lending is?
Yeah, I mean, I can't guide whether or not that's a good investment. But yeah, you typically lend your cryptocurrencies to a platform like BlockFi. You generate interest payments every month, and on the back end, they're lending it out to asset managers or traders that are using it as for margin.
Could you expand a little bit more on how leverage is used?
Yeah, it's used to increase your exposure in one direction or another. You can manufacture short positions with leverage. In the case of like leverage trading, it doesn't feel like you're manufacturing anything, but you're just taking a long or short position with however much leverage. There's several trading strategies that when we talked about the high rates of leverage that some venues offer. I think Binance still offers 100x leverage. It's not anything useful for a human to use, but if you have an algorithm that's going to take 100 trades and most of them are going to fail, but some of them are going to capture some meaningful return. There's certain strategies that particularly quant strategies where leverage is preferable.
And maybe you could go a little bit into also the distinction between lending and staking.
Yeah, I mean, it's sort of the same thing. It's really just like what is going on in the background. Lending, they're providing this liquidity and people are borrowing against it. Depending on, the utilization rate of that liquidity and the volatility of the collateral, there is a bit of risk of, insolvency at the protocol level. Most of these things are over collateralized, but just given, the velocity of collateral and the volatility of the collateral, like there is theoretically always that risk. In the case of staking, it's more like locking up rather than, providing this, to somebody that's using it at a different venue. So staking is more of just a way of taking that circulating supply out of circulation, and in return for that opportunity cost, providing some sort of reward for it.
And Dara, I see one question I want to answer real quick. When I said we'll see what you get on a minting event, let me just explain real quick. So on these collections, part of a lot of popular ones is that they have varying attributes, like these crypto mutts. Different heads, different shirts, different backgrounds, and part of, for the collectors of them, what drives the value difference across the collection are different elements of rarity of when different attributes occur. So it's like opening a pack of baseball cards. You don't know what's actually in the pack. Is it a rare card or a common card? So that's what I meant by that. So like when you mint, you don't know exactly which one you're getting. You're getting them in a sequence of how an algorithm decided which ones had different attributes. And after you mint it, then you'll see which one of that type of collection and what attributes yours has. So I just wanted to clear that up.
Yeah, this was a fascinating discussion. Thank you so much, Jahan and Blake. And thank you everyone for tuning in. At some point later on today, tomorrow, we'll follow up with an email. You could have a link to the replay, a link to the DeFi white paper that Jahan referenced, as well as we'll put the slides up there as well. And we look forward to seeing you at the next one, which will be Tuesday, November 9th, same time, same channel. So this is exciting. I'm actually looking forward to watching this one again because there's a ton of information and really, really helpful. So thank you very much.
Thank you. Thank you, everybody.
Thanks, everyone.